Hey Shane, how's it going?
It's going well. I just got some coffee delivered behind me. I don't know if you can see that, but at least it's blurry. My wife was delivering me some afternoon coffee.
Sounds great. And I know you were golfing earlier, so it looks like true to form. We had a sell off while you're playing, and then we got the rally after.
That is generally how it works. Yep, I definitely saw some sellers while I was on the course. Soon as I finished up, we started staging a rally in the indexes. So that is par for the course. Ha ha ha.
Perfect.
Pun
Well,
intended.
today's July 21st, 2022 for everyone watching. And Shane, if you want to kick it off, I think we're going to start with the SPY.
Yeah, and we got a little bit of a different mechanism here to share charts with you guys. Find that the using a live trading view chart is sometimes problematic, just because there's a cursor and it doesn't follow in real time using when we're on Zoom, and so we're going to try this, and if it doesn't work, we'll go back, or if we need to go look at the live chart online, we can do that. But for now, we're going to start with some charts that Kyle and I prepared to run through for you guys. Just saved them in a PowerPoint. So we'll kick it off like we usually do with the S&P 500 using the SPY ETF SPY as the symbol. So the same lines that y'all have seen from us before, and I am quite surprised that we made it out of this down channel that you see over here on the right. This just black area. We were stuck in that for quite a while, going back to April, and it looked like it was going to hold here a couple of days ago, and Kyle and I were debating whether or not the bottom was in, and I said, "Oh, it's stuck in this channel. I think we're going back down to make a fresh low." And so we get first, price tried to go up and then got rejected by the down channel and this red 50-day moving average. And so I thought that was it. I thought we were going to make a new head lower. I don't know if we were going to make a new low immediately, but I thought we would head lower. I thought the momentum down here would flip red, and so I've since been surprised by the strength in the bounce. And at this point, I don't think we'll probably turn lower until this gap fills. You can see this gap high here at 401, and if we zoom in a little bit, you can see it a little bit better. So we got a little bit of room, maybe five more points of upside before we fill that gap. The gap I'm talking about, by the way, for those of you who may not know, is this little area right here where there's no price that fills in that gap. It just kind of jumped lower and jumped lower here. See how the gap filled and then turned around. So that's a trading strategy, right? Looking for gap fills. I think now that we're in the gap, I think it's likely that gap will fill before we turn lower. And now, since we're above the 50-day moving average, that 50-day moving average is going to act like support as we drop back lower into it. So maybe we're starting to inch our way out of the woods on the S&P 500, and maybe the lows for the year are in. I guess we'll find out.
Absolutely. So we'll see on that one. And this is one of those two you always kind of look for confirmation. So you know what I want to see is I want to see a backfilling day. So I want to see it sell off and come down and test that 50 and hold. And I think for me, that's giving a little clear indication that we really have something here. But with the Fed next Wednesday, I'm cautiously optimistic. I am, I've picked up some longs, but it's really still needs to be proven.
Yeah, I mean, even you say backfill at the 50, like obviously that would be good, but I don't even know if there's enough downside there for me to get super confident. I think you even have all the way down to this purple, because right now you've got the low, and then you've got a higher low, and now we're breaking out above the 50. I think we could come all the way back down to this purple line. And as long as that purple line holds, I'll be constructive, more constructive than I've been in a long time on the S&P 500. And it doesn't mean anything. I mean, oops, I didn't mean to do that. It doesn't mean for sure anything at all. I mean, we had a low here and then a higher low and a higher low and a rally back above the 200-day, only to ultimately roll over and come back down. So we still have the 200-day moving average all the way up here. That's going to act as resistance. If we can even make it that high, we've got this 415 level, right? It was a low here. It was a low here. It was a high here. So this 415 level is pretty strong resistance at this point. And we're up only 9% off the lows. That's all this is. This is a 9% move. If we get to fill this gap, that'll only be a 10% upside move off the lows. So that happens during bear markets all the time, and it doesn't mean that the bear market's over. In fact, we'll get to a couple of charts shortly that will kind of solidify that. So just because the market bounces 10% off its lows doesn't mean anything. We're up 10% from the lows, and we need to go up another 21% to get back to the all-time high above 479 up here. So if you're bullish and you're looking for a reason to buy, this isn't a terrible place to buy. Even if you put your stop all the way down here, you're risking, call it 10% to make 20%. It's not the best risk reward in the world, but 2-to-1 isn't terrible. I've seen people make worse trades than that and come out on top. So yeah, I'm the most reluctant bull ever. We've been buying stocks for our clients, but that's only because we were very heavy cash at Elevate across our strategies. We were well over 65% cash, and our strategies have been for a while. So we bought our first stocks at the end of June, since April, and we've added, I think, 3 more stocks so far in July, and we've taken partial positions in each of them. So we're not aggressively buying. I am, again, a very reluctant bull at this point. I'm more bearish than anything, but while I'm thinking about it, the economy and the stock market are two disconnected things. Like, the economy is total crap. It's like there's nothing good about it. Prices are high. The job market's super tight. GDP is coming down. I mean, what else? We can probably think of a whole bunch of other things. Companies are laying people off. Ford just said last night that they're laying off like 8,000 people. The list of tech companies that have slowed hiring is very long. Google just said they're going to cease hiring for 2 weeks to evaluate their staffing needs. I'm betting that in 2 weeks they don't come out and say, gosh, we're understaffed and we need to hire a bunch of people. So anyway, I think there's a lot of reasons to be bearish, a lot of economic calamities out there, a lot of political nonsense out there that you don't want to probably be too optimistic about. I think there's a lot of reasons to be skeptical of the market, but that was true for all of 2021 as well. And as we know, the S&P 500 during this time frame between these yellow lines here, right, that was 2021. The market, the economy was terrible then, and it went up anyway. The big key there is that the Fed was stimulating the economy with bond purchases. So that part's a little different now. But all they have to do is back off of their hawkishness and the market will find a reason to rally. So they've set up for their meeting next week that they're going to hike interest rates by another 75 basis points. If for some reason they come in at only a 50 basis point hike, the market will shoot higher, maybe up to that 410, maybe even the 415 range. So who knows? Next week's going to be a big week.
And the big thing too, Shane, is if you're relying solely on predicting what the bottom's going to be, what the top's going to be, it's very unlikely you're going to be successful investing. When you have sell-offs like this, put a little capital to work. It's not all or nothing.
Yeah.
So having some money in the market now, if you're right, you can always add more later. But if you're wrong, it's not really going to hurt you. And the other thing is you're preserving mental capital. And that's so big in investing. It's just, you don't want to sit here with everything at stake, fretting over the market. You want to just kind of stagger in, be at peace with it, and it works out in the end. But yeah, we're never trying to pick the bottom or the top with all of our capital. That's a very poor strategy.
Yeah, no, we've been over it lots of times. I don't pick bottoms anyway. Bottoming is a process, not an event. And so, yeah, we weren't 100% cash when we were super bearish. And we don't need to put all of our cash back to work now that there's some signs that the market might be trying to finally put in a bottom. And here's the other thing I'd say is don't add, only add to your winners. Like if you put some of your capital to work and it starts going up, that's the one you add to. If you put some of your capital to work in something else that starts going down or makes a new low, don't average down. Don't buy more of the losing position. That's the key mistake most people make, is they'll say, well, I liked it at 100. I love it at 90. No, that is not how it works. You want to buy the stocks that are the strongest off the bottom, or anytime, even during a momentum rally. You add to the winners, you cut the losers off. You don't want to own the laggards. You don't want to own the relative weak performers. You want to own the best of the best all the time. So if you buy a position and it starts showing you a loss, don't buy more of it. Like, just don't do that. That's a real bad way to make money trading. Even though, you know, in a perfect world, as long as something doesn't keep falling and you wouldn't sell, like it makes sense to the human mind. But what happens most of the time is when people average down, is they just keep averaging down until they finally say, I've had enough, and then they sell for a massive loss. Or sometimes the stock will go to zero. That's, less frequent. More frequently, people average down and then end up folding later and say, you know what, I've had enough of this. There's so many stocks in the market that are going to go up a lot once the market bottoms. There is no reason to own a dog. So don't buy more of the dogs, buy more of the ones that perform well. Even if you're buying at a higher price than where you bought it originally, it's just confirmation that you're right. Put all your money in that, not into the one that's going down.
Absolutely.
All right. Anything else on SPY? I don't know. We might come back to it because we got big week next week coming up. So anyway, let's jump into Qs unless you had something else.
No, we're good.
All right. Qs, same sort of down channel that was in there for a while. And now we're out of the channel. We're above the 50-day, almost back to the point where we started the year 2021. So NASDAQ for now still trading below where it closed back in 2020. So it still erased all of its 2021 gains, but showing signs of life, up a fair amount off the lows, and looking strong. So I think we're going to run into some resistance here at 313. Back here in June is where that rally failed, and then we rolled over to a new low. So again, same idea. Like, this was a high, and then this was a higher high. So from here to here, that's a bullish technical indicator. And what ended up happening was a fresh low. So you can't just, technical analysis isn't perfect. If it worked every time, everybody would do it. And, this game would be easy, but it's not easy. It's very difficult. And you never know what's going to happen until it has happened. But I see, a higher low and another higher low. So that's a couple of higher lows now for the NASDAQ using the QQQ ETF and trading back above the 50. Well above the 50, like more above the 50 than the S&P 500 is. So on this one, I would agree. Like if we get a backfill towards the 50-day, or even towards this red trend line here connecting the higher lows, like as long as it stays above that area, we could have seen the bottom in the NASDAQ, despite interest rates going higher and the economy being in shambles and the Fed tightening into incredibly high inflation and slowing GDP. I mean, all these things are still true, but investor sentiment got too bearish. Too much cash on the sidelines means everybody who wants to sell has probably sold. And once that happens and there's only buyers left in the market goes up. That's just how it works. So as much as I may not like it, there's some strength here, and I think if you've been sitting on cash, and you've been sitting on cash since way back here, you've created some separation from where the market is, and you'd be crazy not to be looking for some good ideas to plug back in at this level. That again doesn't mean put all your money back to work. It means start looking for your best ideas and start kind of dipping your toe in the water, as they say.
Yep.
Did I cover it all? You got anything on that?
I think, I don't have much to add. It's kind of been the same thing between NASDAQ and SPX or SPY. pretty similar, but the one thing I'm looking at here is the fact that we based a little more in a from a time perspective. So we've been grinding sideways now for about a month. So it gives you a little bit more of a base to launch off of, but I still, like you're saying, I want to see that backfill. So I want to see it sell back, hold, and then it could, potentially go higher. But like you said, the biggest thing people need to understand is that these are the this is the stock market. This is not the economy. So this could lead us out from a price standpoint long before the economics follow.
Yeah, that's a good point, actually, that you made there too. The NASDAQ peaked back here in November of 2021. So, it peaked almost, I guess, a little over maybe a month and a half before the S&P 500 peaked. So, the NASDAQ's been declining for 6 weeks longer, call it. It's declined a lot further from the peak all the way to the low. And so it's no surprise that this might, start to bottom, or, enter that bottoming process ahead of the S&P 500, and maybe work its way out of it a little bit more quickly too. Again, interest rates being higher are usually bad for growth stocks that finance that growth with new borrowing. You got to disconnect the economic situation from what you're seeing. I mean, these prices reflect humans in the market behaving and making trades. And so when it says up, it says up, regardless of what the economic situation looks like. So, so yeah, good point. Good point there. Anything else on that?
I don't think so.
Okay. All right. Next is just a look at the S&P 500 during the 2008, 2009 great financial crisis. So these are some reasons to not get too carried away with putting all your money back to work. Unless you're going to follow some tight trailing stops and get out if you are wrong, then go as big as you want. But from here, October, I think of 07 is what that would have been, to March of 09, that was the bear market during the financial crisis and the mortgage meltdown. The S&P 500 dropped about 57% over that time frame. And it did so despite a number of rallies. I didn't even highlight all the rallies. There's another one right here. There's another one right here. So I could add more, green up arrows to this, and maybe I will for the next time we look at it. But, there were at least these four. This one was only 9%. So not that big of a rally. That's about where we are right now, right? So S&P 500, like I said, is up about 9% off its lows. You can tell here we made a higher low, a higher low, a higher low, a higher low, and then wham, a crash. Same thing here. Higher low, a higher low, a higher low, a higher low, a higher low. Like, there are a bunch of higher lows, and this 14% rally got rejected by the 200-day moving average and rolled over to a fresh low. Same thing here, got above the 50-day moving average, making a bunch of higher lows and higher highs, and smack, rolled over. Same idea here. There's actually two rallies in here. I think you pointed that out to me before. There's like a rally from here to here of 20%, and then from here to here of another 20% in very short order. And then bam, we roll over again to new lows, and we get a rally of 26%, with higher lows the whole stretch and higher highs the whole stretch, and then smash, rolls over again. Oops, that's the problem with PowerPoint right there. I hit my little scroll wheel and we go to a different page. Sorry about that. But anyway, there's a lot of different, there's another rally here, right? And then it got smacked by the 50-day. This one got above the 50-day moving average, just like we are today, only to end up rolling over to a fresh low, and then consolidation and a fresh low again. So just because we were rallying 9% in the S&P 500 today doesn't mean anything. We could rally 20% and it still wouldn't mean anything. We need to make a new high, new all-time high, which is a long ways up, and that's when the bear market's over. So you don't want to wait for the bear market to be over to start putting your capital back to work. I don't think you need to aggressively buy anything until you know that the bear market is over and maybe the economy turns for the better, or at least the Fed starts easing its monetary policy. I
Mhm.
mean, there's a lot of things that kind of go together for when you want to maybe aggressively start buying. I don't think we're there yet, even though we might have already seen the bottom of the bear market. Again, I'm not calling for that. I think we're going to make a new low. I think we're in one of these bear market rallies that could have some staying power. We could rally all the way back up to the 200-day moving average right here, just like this one did. And we could just be in the beginning stages of this bear market, as I will show you on the next slide. But did you have any comments on that, Kyle?
Just back to that idea I was talking about earlier about position management is that, you know, you don't want to chase markets higher. And that's usually when people say, I want to buy more, is when it's so high. And here we are with bargains, and people oftentimes are reluctant to buy. But the key point is, look, if you only put 25% of your portfolio in the market and you have one of these 20% rallies or 20% drawdowns, that represents 5% risk to your portfolio. So you can start putting some capital to work. And when it's volatile like this and uncertain, it's not really that big of a deal because it's just not going to impact your overall portfolio. And when you finally get that big all clear sign, and that might be crossing the 200-day, put the rest to work and you'll catch up just fine. But if you try to pick a spot here and you're watching these videos and you go, okay, this is it, and you put that whole portfolio to work, you're going to have what, I mean, in this case, look like at least a year of sleepless nights and a lot of, upset stomachs, I'd say.
Yeah, yeah. Well, you nailed it. I mean, picking the bottom is difficult. What do you call a stock that's down 90%? Well, a stock that went down 80% and then dropped by half again. You can do that math and check me, but if you have $100, right, and you lose 80% of those dollars, how much do you have left? Kyle, you're a math whiz. You should know this. If you have 100 and you lose 80, what do you have left?
Get 20 bucks left.
That's right. So if it drops by 50% from 20 bucks, how much you have left?
10.
10. And if you started with 100 and now you only have 10, well, it's down 90%, right? So a stock that drops 80% and then drops half again is down 90%. And here's the thing, is any stock that goes to zero has to drop by how much on the final day?
I guess it'd be 100%, right?
That's right. I don't give. So if you started with $100 stock and now it trades at $1, how many percent downside is there from there to zero? 100%. You can lose 100% of that $1. So, picking bottoms is gives you stinky fingers. That's the only thing you can be sure of. And you can, sometimes eventually, as long as it doesn't go to zero and you keep trying to pick bottoms, eventually you probably will be right because I have long-term faith in the stock market. I don't think it's going to go to zero.
Yeah.
So eventually you'll be right. But it's like the guy who says, well, if I go to Vegas and I play blackjack and I just double down on every single hand, eventually I'm going to win one and I'll be back to where I started. Okay, good theory, but let's see you do it. Let's see you lose 10 in a row starting at a $5 bet, and you double it every time, right? So 5 goes to 10, 10 goes to 20, 20 goes to 40, 40 goes to 80, 80 goes to 160. And so, I mean, how much you really gonna go, And sure, the odds say that you're bound to win one eventually, but like you could be risking $100,000 before you know it in that strategy, and you might become insolvent before you finally hit that winning hand. And by the way, if you hit the winning hand, you're only back to even. You have no gains.
Yeah.
It's like the silliest thing ever. And it's no different trying to pick bottoms in the stock market. What you want to do is wait until you break above trend and you put in some higher lows and you're above one of the major moving averages or all the major moving averages ideally. And that's when you can get aggressive about buying stocks again. So we don't have to pick the bottom. We have the rest of our lives to buy the bull market on dip when it finally develops. And that's when you buy on dips. You don't buy dips during a bear market. You buy dips during a bull market.
Yeah.
That's a big misconception that I think a lot of people have is like, they say, well, buy on a big down day, not during a bear market. You know what follows big down days in the bear market? Bigger down days. I mean, just look at this big down day right here. Just as in one example, this giant down red candle, and you're like, oh, there's a dip, I'm going to buy it. And 2 months later, you're down 30, 40%. So anyway, yeah, there's a lot of learning in a chart like this, but again, I'm not super bullish. I'm like the most reluctant bull ever. I think we're probably in one of these bear market rallies, which could easily go up, 26% only to roll over and make a new low. So we'll see how it turns out.
Yep.
The next chart is kind of the same. It's just a different look at the S&P 500 during the 2008, 2009 deal, because I kind of think that this is at least possible right now. But if you look at just this first part from October of 07 to September of 08, it's basically a full year, right, of the market making new lows, new lows, new lows, lower highs, lower high, lower high, lower high, lower low, right? So steadily trending down 24% over the course of 1 year. During that time, you had two of, the bear market rallies that happened. But it was just a kind of a slow, orderly drawdown for about a year. And then a 6-month crash. So it dropped by twice as much, almost twice as much in the subsequent 6 months. So if you had bought every dip during the first 1 year of this bear market, over here, by the time March of 09 rolled around, you would have been down like, you'd have lost half of your money, only buying on big down days, and you'd be wondering what the heck happened. Like you would be probably out of capital. You would be throwing in the towel saying, just give me all my money out of stocks, buy me a bond, buy me some cash, buy me anything but the stock market. You know what I mean? So I think it's interesting that, I'm not saying that we're in a great financial crisis right now, but I would say that like we're in a very unique situation with prices being abnormally high. By the way, this isn't in our deck, but if you looked at CPI the same way that it was measured back in 1980, last time inflation was like this high and Paul Volcker raised rates, inflation would be almost 20% right now, not 9.1. CPI would not be 9.1 like it was last month. It would be like, I think it was like 17 or 18% when I looked at the chart.
Yeah.
So it's amazing how the government can manipulate things to, be in their favor. But if we were measuring it the same way as we used to, we'd be literally talking about all-time high inflation right now. And they still have the overnight lending rate lower than neutral. So they're still accommodative. They're still stimulating the economy through very low interest rates, and inflation is, as high as it's ever been in my lifetime. So it's a crazy thing, to see that happening. And then meanwhile to see GDP, down in the first quarter and projected to be down again in the second quarter. We'll get that number next week on Thursday, the day after the Fed comes out with their interest rate hike announcement. So we don't know how much the Fed will hike by, if at all, and we don't know what GDP will be, but I'm pretty confident the Fed will hike by at least 50 basis points, probably 75, maybe 100. And then the following day, we'll get the GDP number for second quarter, which will probably show the second straight quarter of declines, all, officially putting us into a recession.
Mm-hmm.
And on that same morning, we get Apple earnings. So it's next week is a big, crazy week. So we'll learn a
Yeah.
lot about what's going on in the markets next week.
And a reminder too. So was it the last two Fed meetings we've had rallies after the meeting, and then the following day, just some of our best sell-offs so far.
Oh yeah.
And now you've got this big rally building into it. So definitely, I'm not going to predict, because again, not good at predicting markets, but from a risk management standpoint, definitely want to be, buckled up and have some stops in place, because they could send some fireworks and make us roll over pretty good.
Yeah, it's okay to have a position heading into things like this, but you better know where you're out, where you're going to say, I'm wrong and I'm out, to cut your losses and keep them small. Because, coming back from a 5% loss is easy. Coming back from a 1% loss is real easy. Coming back from a 80% loss, you need 400% of upside to get back to even. So you want to keep the losses small and the winners big. And that just means appropriate risk management, knowing where you're going to get out before the emotion hits you. Trying to determine when you're going to get out while you're getting crushed is, you're going to make a bad decision. I don't know if I've said it on this call, but I have a client who said, yeah, I've never found panic to be useful. And he couldn't be more right. You never hear anybody say, and then I panicked and everything worked out great from there. That never happens. So the way that you avoid panicking in the market is to predetermine your exits. Anything else there?
Nope.
All right. This is the yield curve. So the 10-year yield minus the 2-year yield on US Treasuries. When it drops below 0, you can pretty much count on a recession showing up within like 18 to 24 months. So we went a little negative there, and then COVID actually happened, believe it or not. Not that the 10-year versus 2-year knew that COVID would happen. But it did trip negative, and then we had COVID happen. So, I mean, sometimes it just works that way. Today though, we went negative earlier this year. It rallied back, and now we've dropped to an even lower negative yield. So that means, just to put this in context, that means you can get more interest loaning the government money for 2 years than you would get if you loan them money for 10 years. That is backwards, my friends. And that's why it signals a recession, because when that's the case, the banks don't do as well. The banks are kind of the engine for the whole economy. Lending kind of grinds to a halt. It just is evidence of things not being right in the overall economy. And so again, the economy doesn't always translate directly to the stock market. But this is the reasons that I'm very reluctant as a bull, because there's just a lot of reasons to be bearish. And it looks like this is going to predict a recession again. I mean, unless GDP really surprises us for second quarter, we're probably already in a recession, probably have been in a recession since the beginning of 2022. And if it turns out to be so, then this chart will have again predicted the future by dropping below 0.
Mm-hmm.
Anything to add?
Not on that one. That is definitely, though, from a fundamental standpoint, a very big indicator of not good things to come. So can't, you always got to look at that and factor it in.
Yep. Next would be 10-year Treasury yield. So again, we were saying here, you can get the interest rate is higher on the 2-year than it is on the 10-year, and here's the 10-year. So it looks like it kind of ran into some resistance there. I think you had nailed that one in an earlier discussion. Do I remember that right? Did you say
Yeah.
it would probably turn around about there?
Yeah, turn around there and then probably move sideways for a little while, and we'll see where it goes from there. But it's probably going to breathe for a while, so could see some sideways action.
Yeah, I think some sideways action makes sense. But you see here, I mean, it's not dropping back down to this level where it had dropped. The first time it screamed up there, dropped only a little bit, went to a new high, dropped to a higher low, and now we're sitting at maybe a higher low again. So just consolidating in this area, and then in all likelihood, unless the Federal Reserve backs off of their hike cycle, higher it goes. Once it breaks through this orange line will then become resistance, and it'll be very unlikely that the 10-year yield drops below that. Overall, I think that would be a good thing for our economy. I think a rate above 3% for the 10-year US Treasury is a good thing overall, especially for a lot of our clients who are retired and are living off of their portfolios. I mean, we haven't been able to loan the government money for 10 years and get a 3% guaranteed yield on it for a very long time. I mean, it's been years. Like this was 2018 was the last time that was even possible. So we're talking, 4 or 5 years ago at this point. And so it's been a long time that savers have been just getting demolished, and it's been forcing people into the stock market. Well, now we're going to have clients who say, what, I can get 3% for 10 years and it's government paper, I'll do that. And so some of that money that they used to have to put in stocks, even if they were income producing stocks like Hershey and Coca-Cola, will find its way into the 10-year bond and other bonds too. I'm not saying that bonds are a good investment. I'm just saying if you can get 3%, like at Elevate on the retirement planning side, and this is more your side of the house, Kyle, but we talk about the family index and we say, who cares about the S&P 500 index? Who cares about the bond, the Barclays Ag index? What we care about is your family index. So what's the Fleury family index? And what do I mean by that? Well, what does the Fleury family need to earn as a rate of return for the rest of their retirement, rest of their life, in order to live happily ever after and maintain their lifestyle and not have to move in with the kids, not have to eat cat food. You know, what's the family index? And if it's 3%, if that's all you need to live happily ever after and not have to ever adjust your lifestyle, then why would you go buy the stock market when you can get 3% buying a 10-year US Treasury? That that would be stupid. We have a canvas in our conference room that says, you know, don't risk money you can't afford to lose to try and make money you don't need to make. It's crazy to risk happily ever after for money you weren't even going to spend anyway. You know, you can't take it with you. What, you going to leave your kids a bigger inheritance? It makes no sense, you know.
Yeah.
And you know, you get all these people who say, well, I'd buy a sailboat if I had more money, or I'd buy an airplane. I mean, you're not going to make that kind of money anyway. So, you know, let's be real. Um, Risking happily ever after for the potential of owning a jet and having the privilege of putting gas in it. Come on, that's just crazy talk. You don't do
Yeah.
that.
And what's the thing to remember here is, like you're saying, if that rate of return works for you, great. And with bonds, then it's hold it to maturity. So that's
Oh
the one
yeah,
thing. You know,
right.
if you don't hold the maturity, yeah, you can lose a little bit more.
Yep.
But so it's that. And then also is for so many years now, it's been this Tina, you know, there is no alternative. Well, now there's an alternative. So
Yep.
who doesn't like alternatives?
Yeah. No, good point again, Kyle. I mean, if you buy a bond here at 3% and rates shoot up to 5%, you're still earning 3%. So in order to sell your bond to someone, you're going to have to discount it because they would just go buy a new one in the market and get 5%. So, you know, again, it goes back to what we said before. Just because you get 3% on a bond doesn't mean you go put all of your money into that and have that allowance for the rest of your life. You put some of your money into that and then you wait and see what happens. If interest rates go higher, go ahead and put some more in. Go ahead and put some more in. But don't get into a situation where you put all your money in at 3% and now new bonds are paying 5% and you're having FOMO and you're thinking, man, I should sell all my current bonds and go buy the ones that pay 5%. No, that's not how it works. You will get killed in the bond market if that's how you're going to trade them. The point isn't to trade them. The point is to buy bonds that you know you can hold to maturity that pay you enough interest to make your world work. If
Yep.
you can do that, you can buy bonds, but don't go buy a bond ETF, because that's the thing, is the people who own these, who run these bond ETFs, they don't hold the bonds to maturity all the time. They buy bonds and they sell bonds based on how many people are buying into that fund or redeeming that fund. And sometimes they're forced sellers of bonds that they'd really like to hold to maturity because they know that selling it at this price is going to be a net loss for anybody who remains in that fund. So in the bond world, stay away from funds. And you know, treasuries are a little different because they're super liquid, but you know, if you have to buy bonds, I would not recommend doing it in a mutual fund or an exchange traded fund. I would recommend doing the research, picking the company, buying bonds that you can hold to maturity. And if it's a United States government bond, you know, even better. Usually they pay lower interest because they're lower risk, um, but yeah, very important that you can certainly lose money in bonds, as we looked at the you know, before we looked at the 60/40 bond portfolio, you know, as measured by the I guess the LQD, the bond ETF, the corporate bond ETF. That thing is down 20% year to date, not too long ago. So you can easily lose money in bonds, but if you hold it till maturity and the company or the government doesn't go bankrupt in the interim, you won't lose money. That's how it works. It's a
Yep.
binary situation. Either they make it to maturity or they don't. But if you start selling it in the interim, that's on you. So anyway, some reasons to be cautious, if not outright bearish. Moving along, some reasons to be bullish again. This is a chart, so it puts a signal date. So these little red dots here, every time this happened. So the S&P 500, after 2 out of 3 days with greater than 87% up volume in the New York Stock Exchange within 30 days of a 52-week low. So there's a lot to unpack there, but we don't have time to get really into it. But it doesn't happen very often, okay? Where there's a lot of up volume near to a 52-week low. When that happens, we put a red dot on, and 1 year later, from each of these red dots, and this is a lot of time. This goes back to 1928, it looks like right here.
Yeah.
So these red dots are happening, pre-World War II, maybe right around World War II. So this is definitely a different regime. So that's a little bit far back for my liking. These ones on this side are a little bit more relevant, but like, look at that one. Pretty much nailed the bottom in the 70s. Pretty much nailed the bottom in the 80s. Hit a bottom again. This one looks like it dropped a little bit lower, but ultimately pretty. 1 year later, market was higher. 1 year later, market was higher. Couple signals during the financial crisis. So some early signals where the market actually fell hard from there. But a year later, I bet it was still higher. And so I think, when we look at all of these recent ones, 1 year later, the market was higher pretty much every time. Back here before World War II might have been a little different. But it's a reason to consider allocating some capital to stocks. Anything to add?
No, I think that's good. And it's risk management, right? So again, not trying to predict the bottoms, but when you have a relative low, why not put a little money to work?
Yeah. All right. And here is the data. So this was the picture, this is the data. And like I said, 1 year later, right? All the signals starting in 1974, 1 year later, 100% of them, the market was higher. So what this is saying is that 1 year later from the signal in 1974, on October 9th, 1974, 1 year later, the market was up 29.7%. In 1982, August, 1 year later, the market was up 41%. So you can see these are some pretty substantial gains for the market 1 year later after these signals, and there were no losses. Back here earlier, pre-World War II, even one after World War II, there were some that were negative, but again, it skews to the positive side. And even like these ones were great. It never was lower. Not 1 week later, not 2 weeks later, not 1 month later, 2 months later, 3 months, 6 months. They were all to the good side. So it's been a pretty reliable signal, but it's not 100%, right? Like there were some times where 1 year later the market was lower. So nothing's 100% in markets. Picking the bottom is very hard. Not impossible, but it's impossible to do consistently. Nobody can do it consistently. Some people are better at it than others, certainly. But again, this doesn't mean you go throw all your money in, like you're saying, risk management. You say, hey, look, this is a good reason to maybe go allocate some of the cash that I have raised during this bear market. It doesn't mean you go put all your money to work. So yeah, 83% of the time positive. Median return was 19%. So that's the middle return. So pretty good risk reward on going and allocating some capital once you get the signal. And we just got this signal. I think was it earlier this week? Must have been earlier this week. So this is very fresh. This is another reason to maybe consider being bullish. This blue line here is fund manager weight. So over or underweight equities. What this is saying is that most global, again, this isn't just the United States, so global fund managers are 40% underweight their target equity allocation. So that means if your target is 50% of the money in stocks, these guys only have 20% of the money in stocks right now. So they're 40% underweight what their target is. That means to get back to target, what do they have to do? Buy stocks. The last time we got anywhere near this low was back here during 08 at this red dot right here, which this red dot was a little lower than this one, right? So this one is right around this low, but neither here nor there. It's an extreme. Here's the thing though. A year later, market was probably higher, from here. Maybe not, about flat. So the last time we got this low, this black line right here is not the S&P 500, it's the MSCI World Index. But last time we got to this low, the World Index still had further to fall. before it finally hit its low, right? So the green dot is when the market actually hit its low, and this is where they were, fund manager weight was at that point. So still at an extreme, right around where we are now. But when it got to the ultimate extreme, there was actually still more downside left. So just because all the global fund managers are grossly underweight stocks does not mean that the market has to bottom here. All the retail traders are probably the last ones to sell, and that's what causes that major puke at that stage,
Yeah.
right? And so, yeah, this was like the orderly decline that we looked at earlier in the S&P 500. Again, this isn't the S&P, this is the world index, so it's not exact, but this is the orderly decline from 07 into 08, and then the puke point where it dropped by 50% 6 months. That's when everybody really started to hit the panic button. And Lehman was going bankrupt and all that kind of stuff was happening. So anyway, again, it's hard to pick bottoms. It's not even worth it, in my opinion. You can buying low and selling high just means buying high and selling higher. That's
Right.
that's the best way to do it, in my opinion.
I agree.
All right. Moving on, reason to be bullish. Boy, we got to wrap this up soon.
Yes.
This is a good chat though.
Mhm.
Average cash balances very high. This usually signals a bottom as well. So you can see cash balances are higher than they were back here during COVID. Back here, October of 16, December of 08. We have a lot more cash out there right now, so they can all buy stocks. So we're gonna pick up the pace. Crude oil, consolidating, back under 100, but above the 200-day moving average, and kind of holding this 92.85 support there. So looks like momentum is trying to go back positive, and we'll see what happens. Still below the 50-day, so got some work to do to get back to all-time high land, but holding support for now. What do you think of crude?
Yeah, I think if it holds that level, I think maybe it's just a couple days left here where just puts in a couple down days and recaptures that 50. I think that would be pretty good signal to maintain along or even add a little.
Yep. I still like the oil producers here. We haven't stopped out of our oil producers yet. As long as oil stays, up near $100 a barrel, the Chevrons and the Exxons and the EOGs of the world are going to make a lot of money. So I think that's a good place to hang out for now, but we'll see if it breaks down.
Yeah.
Cannabis is something that you might want to take a peek at. Cannabis is down 81% from highs, and this is MSOS. You can't see the symbol behind this down channel that I drew. MSOS is the United States cannabis. So very important. I would not buy cannabis companies in Canada. The Canadian market is just in shambles. I don't think it'll ever not be. It's like super communist over there. Very strange. It's just not something I'd want to be an investor in. Even though there are stocks that trade with 4 letters and don't end with an X and all that kind of thing. If that's a concern to you and you don't like buying pink sheet over the counter cannabis stocks, just use this ETF. They go out and buy all the US operators. The US cannabis operators are obviously the companies that will benefit from US legislation that would make cannabis not illegal at the federal level. That's cannabis not being illegal federally in the US isn't necessarily going to directly impact the results for a Canadian cannabis company. Hopefully that makes sense.
Yeah.
The market doesn't seem to care. They buy all the cannabis stocks the same without thinking that way about it. But if it were me, I would use MSOS. It's the United States Cannabis Fund, and showing signs of life. Still not out of the down channel, but ticked above the 50-day moving average yesterday for a little bit. Looks like we're back below that now, but we got a higher low, and I would put my stop right around this purple line. If it drops below that, probably going to keep going lower. And you see, we've gotten to the 50-day a couple of times before, and this time it got way above it. But mostly the 50-day has been really, really strong resistance this whole move, and so it looks like it's just trying to behave that way again. But when this finally breaks out, you got 400% upside back to the all-time highs. Again,
Yep.
not saying that'll happen, but I think long run, cannabis is probably going to be around, and it probably will be legalized in the United States. And I don't think people are going to stop partaking.
Yeah, and I think, I mentioned before the call on my Yahoo homepage, which sometimes is about as good as TMZ for financial information, but they were mentioning something about decriminalizing, passing a bill to make that happen in the US for marijuana. And if that happened, there would be a fundamental catalyst right there. But like
Yep.
you're saying, this is one, let it break out of that channel. If it does that and starts that uptrend, you have a lot of time and a lot of elevation to recapture.
You got it. Forward PE ratio. So I don't know, a little over 10% of the S&P 500 is reported second quarter earnings, and those earnings are coming down by about 12% on average so far. So right now it looks cheap, but see this PE, this is the forward PE. The latest is 15.94. Well, the E in that equation is dropping. So as the E drops, it forces this number to go higher, which means more expensive for forward PEs. So even though it looks cheap right now, kind of see how this happened? Boom, boom, and it got more expensive right here. This wasn't because the stocks went up a whole bunch. This was because the stocks actually went down during COVID. And the earnings went down so much that the prices didn't go down by enough to keep pace. So on a PE basis, they all got a lot more expensive. So 22 times earnings coming out of COVID. And now we've worked back into a reasonable range. But what's going to happen as second quarter earnings come out? Is this thing's probably going to spike higher. We'll see. We're still early in the earnings season, but that's what I'm watching now. Is it looks cheap, but earnings are coming down. So as the E comes down, it forces the value or the ratio higher.
Yep.
Gold. All right. So don't want to spend a lot of time on gold, but it has come all the way down to the lows back in March of 21. This low held in July. Well, no, I guess that was probably August by then of 21. And so, oops, we are back there now. We dipped hard and starting to rally a little bit today. So long-term holders of gold might want to nibble on some gold here if you don't already have all you want.
Yeah. And this is one where the trend is pretty sideways, but you're at the bottom end of that trend. So the risk reward looks pretty good.
Yeah,
So,
this is not a trade. I would not buy it as a trade here because I'm not a bottom picker. But if you bought it here, you put your stop at 1673. If it drops below that, you're probably wrong and get the heck out. So not much risk compared to the upside potential if you're right. I don't bottom pick, so that's not my style. But as a long-term holder of gold, as a store of purchasing power, that's where I'd be a little bit interested in nibbling. Again, if you were trying to own $1,000 worth of gold, just as an example, you might go buy like $50.
yeah.
Like this is not a place to be aggressively buying, in my opinion. You might feel different.
No, same. So this is that mental capital side and position management. Put a little in, that way you don't have to think about it too much. See what happens, but it's not something where you go, this is the golden trade,
That's right.
pun intended, to go and put it all in.
All right. We're gonna wrap it up quickly with Bitcoin. Bitcoin, this is the long-term chart. Remember, we have the 80% drawdown from highs as our target. So that would be from here all the way down to here. And that also coincides with an old high back in June of 2019. So that was my original target. We were talking about it back here. I thought it could drop all the way to 13.8. I still think it can. But it broke out of this level, broke above the 50-day moving average for the first time in a real long time. So I actually took a position right around here, and I've got my stop at the 50-day moving average, which we're trading under right now, I think, right around this red line 50-day moving average. So I bought right around here, and I put a stop right here at the red line. So if it closes below that red line, I'm gonna admit I was wrong, and it's probably not breaking out. If this breakout fails right here, it probably will drop to a new low, and that'll bring our 13.8, back into play pretty quickly. So
Yep.
I'm not real. And by the way, if I bought 20%, no, I think I bought 10% of my target position size is what it was. So back in my example on gold, if you want to own $1,000 of Bitcoin, I put about $100 in right there. So I didn't go bet the farm on Bitcoin because we got a breakout. That would be kind of misguided in my opinion. I put a little bit to work, and if it keeps going up, I'll keep adding to it. But if it drops below my stop, I will exit and I will look for a new entry point. So that is, I think that's all we got time for today. Sorry for the long call, but hopefully it was good content for everybody.
Yeah, I think it was good. So hopefully everybody enjoys the content and gave a pretty deep dive this go around. So thanks everyone for tuning in. Be sure to like and subscribe, and we'll see you next Thursday.
Yeah, we'll try and keep it to like 10 slides next time, maybe.
Yeah. Perfect. Well, thanks again, Shane. You have a good week.
All right, later, man.
See ya.